Welcome to our final presentation on bonds where we will discuss yield spreads and the yield curve and its importance in predicting what's going to happen in the economy in the near term. And then bond valuation, which should look vaguely familiar. Present value. And we'll end with some odds and ends about bonds. So let's get started on slide 20 with yield spreads. Now, in the industry, you'll often hear the word spread used for the difference. Remember the ask and the bid prices back in chapter 3 with stocks? Yes. So spread often means a difference. So one value subtracted from another value. And yield spreads are the differences in interest rates that exist among various sectors of the bond market. In general, the shorter the maturity, the lower the rate. The longer the maturity, the higher the rate. Now, this makes sense, and we'll discuss this, and we'll take a look at this in a little bit more detail soon. Because the longer the money is out there, there's more of opportunity for things to go wrong. But there are exceptions. And also, in general, the higher the rating of the bond, the lower the interest rate, and vice versa. And this makes sense again. If you don't have a very good credit rating, the banks and the credit unions are going to charge you a higher interest rate than people who do have a very good credit rating. Treasuries tend to carry the lowest rates because it's the United States Treasury. And I don't care what anybody says. Barring serious stupidity, the United States will pay its debts. Now, muni bonds are the next. But often you might say, hey, wait a minute, this muni bond is paying less than the treasury bond. Remember, we have to do the after-tax calculation, taxable equivalent yield. Exactly. General obligation bonds usually pay less interest than revenue bonds. And as we discussed in the previous chapter, many savvy bond investors just love those revenue bonds, assuming they've done their research. And then corporate bonds are paying the highest rates, non-callable paying less than callable bonds. So slide 21 shows, thank you, Fidelity, one of the last places where you can get stuff free for good information about bonds. The yield spreads as of February 17th, 2025. And we see pretty much what you saw when you did chapter 1 assignment. The 3-month, 6-month, 9-month paying a little bit more than 4%. And then going out to 5 years, 4.6%. But some of you noticed that the 5-year CDs were paying actually less than the 1 or 2 year CDs. But this is what we typically see. We don't usually typically see this small a spread, tight a spread between 3-month and 6-month and 3, 4, 5 years. But that's what's going on now, very tight. And we see the same thing with treasuries. But wait a minute. The 1 year is paying higher than the 2 and the 3 years. But then the 5 and the 10 year and 20 and 30 year go back up. Interesting. Why we would expect to see the 3-month, the 6-month, the 9-month paying less than the 1, 2, 3 year. The curve has inverted. And notice that as we go down the pecking order to corporates and then municipals, they wind up paying higher rates to where a triple B, right, the lowest of the investment grade, once you get below triple B, you're in junk status, over 20 years. Well, this is a bit of an anomaly that the 10 year is paying more than the 20 year, but the 30 year is paying almost 8%, which, for a bond investor who's looking for decent interest, that's not a bad interest rate, almost 8% over 30 years, assuming the company doesn't fall into in non-investment grade, into junk status. Yeah. But still, bonds are back. In general, 5, 6, 7%, a little bit higher if we're willing to take more and more risk. But the low end is paying 4 or 5%, still pretty darn good. Notice, as we said, the municipals seem to be paying less, but that's because we're not taking into account the taxable equivalent yield. So Often investors will speak about the bond spreads as being tight or wide. A tight spread means the interest rates among the bonds they are evaluating are very close to one another. So, for example, Treasuries paying 4.8, corporate bond paying 5.1%. Now, what you're going to hear is the term basis point, and we asked you to look that up, back in chapter 3. That's a silly name for 0.01%. So 100 basis points would be 1%. 30 basis points here is the difference, 0.3% between the corporate bond paying 5.1 and the treasury bond paying 4.8. In that case, it makes sense to buy the treasury bond if all other things being equal, and they never are, because you're getting a whole lot more reliability for not accepting a whole lot less in return for your investment. Whereas a wide spread means that there's a big difference between the bond interest rates. Treasury paying 3.2%, but a corporate bond paying 8.2%. That's a full 5% more, or 500 basis points. Yeah, you might take a second look at that corporate bond and say, you know what? That's a pretty darn good interest rate. That might tempt me away from the stability of treasury bonds. During the turmoil of 2008 and 2009, the yield spreads widened to levels not seen in decades. Corporate bonds were just in terrible distress, so the yields skyrocketed, whereas people ran to the safety of treasury bonds. They narrowed significantly during the 2010s and now have widened somewhat since 2022, when interest rates started to rise. As we said, experts in the media use the term basis point to signify 0.01 of a percentage, 0.01%. And so if you just think of 100 basis points equals 1%, that usually makes it easy to cut through the jargon. Slide 23. The yield curve is a graph that represents the relationship between a bond's maturity and its yield at a given point in time. And we also use it to make comparison amongst types of bonds. Now, normally the yield curve is upward sloping, which means that the farther out you're going to go, the more interest rate you're going to get. Longer term bonds have higher interest rates than shorter term bonds and treasury bills. Sometimes it inverts. Sometimes the yield curve is downward sloping. It's called the inverted yield curve. In this case, shorter-term bonds and bills have higher interest rates than longer-term bonds. Interesting. Why would that happen? Here is the typical upward sloping curve, this magenta slope you may be seeing, the normal yield curve. Here is an inverted or downward sloping yield curve, this sort of burnt orange or brown graph. This is the dreaded inverted yield curve, and we'll see why it's dreaded soon enough. Slide 25. Why do longer-term debt securities normally have higher interest rates than shorter-term debt securities? Well, there are three common reasons that are hypothesized. The shape of the yield curve reflects investors' expectations of future interest rates. Well, that's obviously true because it's all about the future, isn't it? The maturity preference hypothesis, because investors tend to prefer the liquidity of short-term securities and therefore require a premium to invest in long-term securities. As we said, the longer the money is being lent, the more opportunity for things to go wrong. And then the market segmentation hypothesis says that the market for debt is segmented on the basis of maturity. So there's a supply and demand curve, you economist lovers, within each segment determining the prevailing interest rate. Now, each of these three theories makes sense. Each has merits. But how do we account for the times when the yield curve is inverted? What factors could cause an inverted yield curve to occur? And what can the yield curve tell us about the future of the economy? Well, slide 27. Since World War II, every time the yield curve has inverted, where short-term rates were higher than long-term rates, the economy has fallen into a recession. There was one exception in 1996 where the economy's growth just hit 0%. It didn't go negative. We didn't have a recession, a contraction of the economy. but it hit zero and then went back up again. So that was the only time it didn't work. The yield curve inverted in 2019 ever so slightly, causing renewed fears of an imminent recession, but then strongly reversed itself as if the virus turmoil hit. The virus turmoil in 2020 hit, and the Federal Reserve Bank lowered interest rate backs down to zero. This is an interesting situation. For about 2 years before the beginning of 2008, the yield curve was slightly inverted. And people were, of course, okay, we're going to have a recession. Maybe not. You know, the bond market was predicting a recession for over 2 years. The stock market, for the most part, didn't believe them. Because this was during the heady days of the real estate bubble. It wasn't until the fall of 2008 that the officials charged with tracking the economy acknowledged that we were in a recession, just as the wheels of the economy were about to fall off and the dominoes started falling. It took over 2 years, but the bond ghouls were finally proven right. So now, why would they call them bond ghouls? Bond investors are often called bond ghouls. Well, think about it, folks. If there's a recession, what happens? Well, stocks get hammered, earnings get clobbered, people lose their jobs, interest rates fall. And what happens when interest rates fall? Bond prices rise. Now, I don't really like the fact that the bond investors are called bond ghouls for this reason. I'm sure that most bond investors are not happy about a recession, but that's what you'll hear, the bond ghouls. In 2008, it took over 2 years for the yield curve to finally prove that, yeah, we're going into a recession. The yield curve now has been inverted for 2 years. Is there a recession ahead? No, well, we'll see. Here was the yield curve in 2019. And this is where it was a very interesting situation. Here, you see, the short-term interest rates were being raised by the Federal Reserve Bank, much to the chagrin of then President Trump. And people were saying, okay, you know, we could be in a recession soon. Now, a president going into their final year of their first term, where they want to get reelected, does not want to have a recession, right? So Trump was screaming at the Federal Reserve to lower their interest rates. Well, the virus had other ideas, and they have, obviously the Federal Reserve then collapsed the lower end of the yield curve. So that, and notice that before that, though, the yield curve was normal. Before October 2020, October 2019, the yield curve was normal. What's this? Not right. That's not right. This was the yield curve in 2019. Yeah, here's 2019. Here's October 20, and then there was 21. This was in 21. Yeah, that's 2019. Yeah, that's right. Okay. Now, here it is, the current yield curve. Now, you got to be careful because it's showing you a year ago and then 2 years. So here's the one right there, the blue. Notice it's just slightly inverted, as we saw back on that on the Fidelity's slide several slides ago. We see it's slightly inverted, but it's essentially flat. As mentioned, when the yield curve inverts, the investment world begins to worry about a recession. Remember, dear students, especially you stock investors, keep a long-term perspective. Recessions come and go. Focus on high-quality companies with growth and income prospects. But whatever you do, don't panic. Right? I think I've hammered this idea over and over again. I know it's not fun. Recessions are not fun. Market downturns are not fun. But they come and then they go. And if they don't go, it doesn't matter where your money is. Some economists are calling it I didn't see this movie, but it was called Benjamin Button or something like that. The guy aged backwards. I don't know. Anyway, they're saying we would normally be going into a recession now because we've had, how many years of an expansion? Almost 15 or so years of an expansion. But we're actually the economy's looking like it's about mid-cycle of an economic expansion. It's going backwards. We'll see, especially if, we have mass deportations and massive tariffs that could throw us into a mess. I don't even want to use the word recession. It could throw us into, I don't want to go there. I don't want to start a war with Canada or Mexico or Panama or Greenland or or Denmark. Yeah. Slide number 30. Okay, so that was bond. Okay, make sure you understand and can explain to your friends, family, and coworkers why an inverted yield curve is a scary proposition, but we keep a long-term perspective because we're ready now for slide number 30. Bond valuations. Well, remember stock valuations? Yeah, it wasn't. It was pretty darn tricky stuff, wasn't it? Kind of. I think it was a little bit better than voodoo or reading tea leaves or tarot cards, but it's still very, very dicey. Well, we're going to find out that bond valuations are a lot easier to come up with because bonds are fixed. Bonds are normally priced according to the present value of their future cash flows. Does this sound familiar? We get semi-annual interest payments, and then we get the repayment of the principal. Although other factors will always need to be considered, such as the credit worthiness of the issuer. Because if the issuer runs into trouble, oh yeah, the price of their outstanding bonds will fall because investors will be afraid of default, right? So they'll dump the bonds. As we saw in the previous chapter, you saw investors just dumping the Ford bonds, dumping the Poway School District bonds because they were afraid they weren't going to get paid. So they said, okay, I'm out of here, hot potato, I'll get rid of it. Turns out they all came back, yeah. So here's the formula. The bond price is equal to the present value of the interest income plus the present value of the repayment of the principal. It's the discounted cash flow model. Folks, you can't leave this class without knowing how to do the discounted cash flow model. It's bad for my self-esteem. What we do is instead of dividends for our income, we use the interest payments. Well, that makes sense. We're going to get that interest. And with bonds, we're pretty much guaranteed, not guaranteed, I shouldn't use the word guaranteed, but we feel fairly assured that we're going to get our interest payments. Then at the end of the bond term, we're going to get the principal back. We're going to get our $1,000 back, or in our class they're always 1,000, but some are 5,000, some are 10,000. So we're going to do the exact same thing we did in chapter 4, and we're going to learn how to do it manually. And some of you are going to use the exponential formula. I wish you wouldn't, because most of you don't do it correctly. And then we're going to use a spreadsheet, which makes life a whole lot easier. So since bonds pay interest normally every 6 months, we really should use semi-annual compounding. But that's a pain in the neck, and that's why we have spreadsheets. We'll just use annual compounding, and it gives us almost the exact same answer. The computations are easily done using the present value tables. Hard to do with the exponential formulas. And then once we've learned how to do them manually, of course, we can use the spreadsheet. So here's an example, Boeing, which has been in the news lately for not all the good reasons. This bond that I found on the 17th, was it? Yes, 18th of February, was paying 3.3%. That's the nominal yield. When the bond was issued, that's what it was paying, and that's what it'll always pay. Remember, 3.3% means $33. 3% would be $3. 3.3% would be $33. You just multiply by 1,000, right? Okay, now, it's due March 1st, 2035, and I use this for a reason. I wanted to get as close to the month that we're in. Of course, we're at the end of February, so it's going to be a few pennies off. We'll see. And it's priced to yield a little over 6%. The current yield is 4.137% because the bond on this day last sold for a little under $800, $797.67. And if you do the calculation, $33 divided by the price, $797.67, you get 4.13%. That's the current yield. But remember, we're going to get $1,000 back when the bond matures. So what's our actual present value? What is it worth to us today? Well, we take the present value of the interest income plus the present value of the principal repayment. So $33 is the payment we're going to get every year for the next 10 years. And then where's this present value multiplier come from? Well, it comes from a new table. So this table is the chapter 10 table, and we want you to print it out. And of course, in the face-to-face class, we would have it for you. And you can't see the years on the left-hand side, but they're there. Now, this table on the right side is the same table that we used in Chapter 4. And we could use this table, but that would mean we'd have to do 10 calculations for the interest payments for the first 10 years. What a pain that is. So, I mean, you could do that, but we have another table, this new table, that calculates a stream of payments. Aha! So we go across the 6%, down to 10 years, and there's the present value multiplier, 7.361. You see that? That's the present value multiplier times the interest payments. So $33 times 7.360. Okay, it stopped again. I don't know what's going on, folks. Sometimes my Google Docs stops the closed captioning. So go to Yahoo, and Yahoo will do it for you. And if you need, well, it's a little late in the semester now, but if you need closed captioning, contact me immediately. Okay, so $33 times the 7.360 gives us $242.88. So think, folks, we're going to get 10 payments of $33. That's $330. But remember, what's the time value of money? It's not worth $330 today. It's actually only worth $242.88 at 6% rate of return, 6% discount rate. Hopefully you're used to that terminology by now. So we're getting $242.88 worth of interest over the next 10 years today. Now, remember, we're going to get the payment of the bond back when it matures. So that's $1,000. But that's a one-time payment. So we go back to our trusty table from Chapter 4, cross the 6%, down to 10 years, 0.558. And what are these guys? This is when you do the worksheet number 1. I put those in there because when people are doing the worksheet number 1, they can figure it out. So 0.558, and we multiply 1,000 times 0.558, and that's $558. And if you don't understand why, just use your calculator. When you're multiplying by multiples of 10, all you got to do is move the decimal point. So the formula is saying that the bond is worth $800.88. The quoted price was pretty darn close, like about $4 less. On the spreadsheet, the bond calculator is much more precise. It's using 20 digits of accuracy, not 30 digits, not 20 digits. I'm sorry. It's using 20 digits of accuracy, not 3 digits of accuracy, as the table uses only 3 digits. So let's run over to the bond calculator, which is on the website. Oops, can't see it. Let's make it a little bit bigger. Okay. And so the gray areas are the information you type in. It was quoted, coupon rate doesn't change, 3.3%. The quote was $797.67. It calculates the current yield, which basically just takes the $33 divided by the $797.67. We put in the maturity date. It says, it's a little over 10 years till it matures. And it's saying price to yield, we put in that 0.0090595 is what the FINRA website told me. So I put the whole thing in. I mean, 6.009 is good enough. And then the principal is 1,000. It's notice Boeing is very close to being junk status, BBB minus, and it's callable yes. And then the formula, the spreadsheet says, okay, hey, there's our present value stream of payments, and it's a little bit higher than the one on the in the table because it's a little bit more than 6 years. So it's saying $800.31 for annual compounding, but here's the semi-annual compounding. And of course, the spreadsheet does it a whole lot easier than we do. Here's the formula. What a mess. It says, you know what? If you get semi-annual payments, which is what most bonds pay, they'll pay us instead of $33 once a year, they'll pay us $16.50 twice a year. Then you actually believe that the price is almost $803, which makes sense. It's selling for about $898. In other words, people are saying, you know what, Boeing? We're a little bit frightened by you. We're not going to pay you what we think is normally the full value. we're going to hedge our bets a little bit and shave a little bit off the price of the stock. I mean the bond, sorry, not the stock. Make sense? And so now is when we would run over. I'm going to make that thing in the left-hand corner smaller because it gets it gets a pain in the neck. And so we're going to now, we would normally run on over to the worksheet, and go away. How's it go away? Oh, forget it. There it goes. No, it's not going away. Why isn't it going away? You ever have one of those decades? Go away. Reset. Okay, not 100%. I didn't want 100%. Go away. How do I get rid of it? I don't know. I'm sorry. There, I got rid of it. Okay, so now we would run over to the worksheet and do the calculations, for the bond valuations. And again, please use the present value tables. They're so easy to use. And if you do use the exponential formulas and you get them wrong, I'm going to give you a sopapo. How's that? A dope slap. I'm going to just say, please. Okay, let's continue. Now we have some odds and ends to finish up with bonds, and then we'll be done. Yeah. Reinvestment risk. Reinvestment risk is the uncertainty about the future value of an investor's bond investments that result from the need to reinvest bond interest payments and redemptions at yields not known in advance. Well, remember, if we're living off the interest, we're living off the interest. But typically, while we're building our nest egg, whether it's through stocks or mutual funds or bonds, we reinvest whatever dividends, interest payments, or principal payments we get from our investments. We plug them back into the our portfolio. So changing interest rates don't normally only affect the price of your bonds. They also affect your future income as you need to reinvest the interest income and bond payments. Yeah, unless you're going to live off the payments, the interest payments and the principal repayments, you're going to plow them back into your bond investments. If interest rates have fallen, well, great, bond prices have risen, but now your income level will fall as you reinvest your income and bond repayments. See, because current bonds are paying less. If interest rates have risen, my bond prices have fallen. Well, great. Now your future income level will rise from reinvesting in higher paying bonds. And this is why, dear students, it's just so important to keep a long-term perspective. Don't worry about what's going to happen in the next 2, 3, 4 months. Think about what's going to happen 5, 10, 15, 20 years from now. Make sense? I hope so. And if you didn't understand that, please contact me, because this is a very important thing about bonds. When people freak out, interest rates are going to rise, I should sell my bonds. No, don't. Because first of all, you don't know. You think interest rates are going to rise, but there are people who are paid tremendous sums of money to incorrectly guess where interest rates are going to go. Okay? And then secondly, if interest rates rise, your bond prices have fallen, but now new bonds are paying better interest rates. Duration. Now, this is something, I don't even know if we should tell you about this, because this is not something that we small investors really normally have to worry about. It's only people who've got tons of money, mutual fund managers, pension fund managers, banks, and life insurance companies. Duration is a measure of a bond price's sensitivity to changes in interest rates and bond yields. It captures both the price risk and the reinvestment risk. It's used to indicate how a bond will react in different interest rate environments. The duration of a bond changes as it approaches its maturity date and current interest rates change. And in general, the longer a bond's maturity, the longer the duration, the higher the bond's normal rate and yield to maturity, the shorter its duration. The shorter the duration, the less potential price volatility and vice versa. So we can use duration to immunize. I hate the term. It's viruses. Investors who have a specified time horizon can use bond immunization to increase their probability of successfully achieving their desired goal. You keep the average duration of your bond investments equal to your time horizon. So the idea was you would thus be more protected against interest rate induced price swings. But what's the problem? You're always rebalancing your bond portfolio since durations of bonds change as interest rates change and bonds get closer to maturity. Yeah, most individual bond investors just don't have that much money to be pulling this kind of stuff off. That's why there are mutual funds, right? So who's going to do this? The mutual fund managers, the pension fund managers. Say you've purchased an intermediate term bond fund. Well, the intermediate term bond fund managers are going to be using this technique because they have millions or billions of dollars to invest and can buy, hundreds of bonds, not 5. So yeah, it's not something that we have to worry about, but you as a investment guru should know something about this, that bond investors have to worry about their time horizon, and that's how they do it, with bond immunization. Okay, what are some bond investment strategies? Let's sweep up here. Well, there are 3 major investment strategies. The income strategy, which is simply the easiest one. You buy the bond and you use it for income. The capital gain strategy, which is the hardest, where you are speculating. And what do we know the word speculation means in an investment world? Gambling. I know we don't use that word, gambling. It's such an ugly word. We say speculating. We speculate that interest rates will fall, or we speculate on distressed junk bonds rising in credit quality and price. So obviously that's the hardest one, right? And total return is a mixture of both. So sometimes you'll see a mutual fund that says the total return bond fund, right? And so they're telling you that, yes, we're interested in income, but we're also going to do a little bit of a speculation to see if we can juice the returns. Whereas a bond fund that says there's such and such income fund, will say, hey, we're interested in income. Got it? Okay. All right. Now, bond laddering. Again, this is something that typically individual investors, unless they got a lot of money, and then you usually have a private personal broker to do it for them. Bond laddering is a strategy of purchasing bonds with staggering maturities. We purchase some bonds with short-term maturities, some with intermediate-term maturities, and some with longer-term maturities. So it's another way to diversify, and we'll talk about diversification in detail in a couple of chapters. Chapter 11. Again, very popular with pension fund and bond mutual fund managers since they have considerable sums of money to invest. Now I ask, what are the advantages and disadvantages of this strategy? Well, the advantages is that you're diversified. And the disadvantage is that you're diversified. What? Well, we'll see. No investment strategy is perfect. And we'll see that diversification in general is a very good thing. But it also, means that you could have done better if you had just stick with the one longer term or stuck with the shorter term. But okay, oh well, that's what we give up by diversifying. Diversification, and we'll say this again, it's a cute way of thinking of it. Diversification means that something in your portfolio every year is going to make you sad. But hopefully it'll be balanced out by something that did well, unless it's 2008, right? So slide number 38 is a bond ladder from 2021. Before the Federal Reserve had to start raising interest rates in 2022 to stave off inflation. So we see that the 3-month, 6-month were basically paying us nothing. And then this is what I just couldn't understand. Who was buying 30-year Treasury bonds paying 2%? Whoever did that in 2022, I hope they never looked at the value of their bonds, because boy did they get hammered when interest rates rose. When interest rates were at 3% for 30-year Treasury, I was telling people, I was saying, you know what, I wouldn't touch those darn things. I'm not trying to disparage the Treasury. I'm not doing that at all. I just thought 3% was horrible. And then it went down to 2%. Thank you, COVID, right? But we bounced back. We haven't had the last word yet. And now we hear people saying we should ban the COVID virus vaccine. Real smart. Remember, nature bats last, and viruses have been around for 2 billion years. So let's fast forward to 2022. Exactly. Here's what, even still, 2.5%. And you see interest rates rising in April of 2022 as the Federal Reserve Bank had to finally acknowledge, oh yeah, this is not transitory inflation. All the economists knew was going to happen. They were hoping the word was transitory. They were hoping it would be a, just a little one shot blip of inflation. They knew it when we closed the economy for COVID. And there were people saying, some people saying, especially the politicians who wanted to get reelected, we should let the economy stay open and let the old people die. That was one of the senators from Texas, John Conyers or something like that. Yeah, and now let's fast forward to today, and we see, okay, I can live with a 20-year 6% A bond, and the 30-year 6% corporate bond, and we saw that the triple Bs were paying almost 8%. But notice, this is what you noticed a few weeks ago when you were doing chapter 1 assignment. Little bit above the 100-year average. And we thought for sure, everyone was convinced that the Federal Reserve was going to continue to lower interest rates as things got slowed down a little bit and got the overheating from the resurgence of the economy after COVID was calming down. And then an unfortunate thing happened where somebody who got elected is saying that we're going to raise inflation. Now, that's not what he's saying, but if we have massive tariffs, that's inflationary. And if we have a massive deportation, that's inflationary. And if we have a war, that's a disaster. So what can I say? We pray, right? And we try to remember the words of Louis Rukeyser, host of Wall Street Week for over 30 years on that communist-inspired television network PBS. This country is so fundamentally strong it can survive its leaders. I'm holding on to that. Praying and holding on to that. Slide 41. So we're done bonds. I know bonds are kind of boring, but they're important, especially when we get older. When you're young, I tell people 20s and 30s, you don't even need bonds. Now, that's a little bit of off the normal recommendations. They often say, you need some bonds, 20% or whatever, even when you're young, to cushion the blow as your airbag when the economy takes a hit. As long as you know not to panic, I disagree. If you're going to panic, then you need more than, maybe need 40 or 50% bonds. Okay, so go back over the worksheets. Make sure you can do them. I would make sure I could do the worksheet number 3. Hint, hint, hint. It might look like something on an exam soon. And we're now ready to burn through hybrid securities. They're not that important. But the assignment will take you all of 10 minutes, and it's good for 5 points, so go ahead and do that. And then we'll be ready to wrap up everything that we've gone through since the beginning of our journey together with diversification and asset allocation. Oh, dear students, we're so proud of you. Think of how much you've learned. You are the investment gurus for your friends and family and colleagues. We are so proud of you.